You're listening to Ask the Expert on Sprott Money News.
Welcome back to the August 2021 edition of the Sprott Money News Ask the Expert series. I'm your host, Craig Hemke, and joining us this month is a new guest. Her name is Lyn Alden. And if you are interested in the financial sector, if you follow things on Twitter, if you go on the internet and look for independent research and analysis, you probably know who Lyn Alden is. She runs a great website that is just simply lynalden.com. You can find her on Twitter at Lyn Alden Contact. And her website and her service is the Lyn Alden Investment Strategy, which has been running since 2016. She is an independent, very independent analyst and investor. And it's great to have her join us. Lyn, thank you so much for your time.
Thanks for having me. Happy to be here.
It's great to have you here. And why don't we start with this, Lyn, before we get to the questions, tell everybody a little bit about your background and the services you provide at your site.
Sure. So my background is basically the intersection of engineering and finance. And so I started out as an engineer, moved into engineering management and running the finances for an engineering facility. And then I eventually shifted more towards investment research and kind of applying that quantitative background. And so my website has a free newsletter that's pretty in-depth. And then I also have a low-cost premium research service on the site as well. So there's a big spectrum of things for people there.
And people it's just Lyn Alden, LYNALDEN.com, correct?
Yes, that's correct.
All right. Hey, let's have everybody check that out. And again, I want to remind everybody, if you enjoy this type of content, please be sure to help us spread the word by giving us a like, a subscribe, a share on whichever channel you are listening to these Ask the Expert segments. Lyn, let's just dive right in. We've been collecting questions at Sprott Money all month long since we announced you were going to be the guest. Excuse me, I've got 6 of them. The first one is quite timely as we record this on Monday, the 23rd. I think everything for this week and next month and maybe the rest of the year is going to be centered around whatever it is that Chairman Powell has to say this coming Friday at Jackson Hole. And you've watched all of this in the last several months as this has played out. What do you expect from Chairman Powell in his Jackson Hole speech this coming Friday?
So the Fed has spent the last couple of months kind of laying a foundation for eventually trying to taper their asset purchases. And so they put out those 2 standing repo facilities. And they've also had a number of Fed officials start remarking around, tapering. Now, they're starting to walk that back a little bit, citing the Delta variant. And so even their Jackson Hole event is virtual now because of that. And so now they have some cover where they could, potentially choose to delay that. And so I would say that, maybe 2 to 4 weeks ago, my probability was more toward that they probably would announce tapering at this event. And that's still certainly possible, but I think the odds are tilting a little bit more towards them probably defining the conditions that they might consider tapering. I'm not sure that they're going to commit to tapering at this particular event, but it's certainly a big question that I'm watching because they're basically seeing that inflation's running hot and there is kind of pressure on them to start doing something about that.
Yeah, that's one of the themes, excuse me, we've been discussing in some of the Sprott Money content this month is whether this, like the rally in the dollar that we've seen since this first came up 2 months ago, is actually kind of a buy the rumor, sell the news event. Is that kind of on your radar too?
That's certainly one of the possibilities. So gold has been under pressure, dollar's been pretty strong. But if they were to, shift back any sort of tapering or basically be more dovish than the market expects, that should theoretically be dollar bearish and gold bullish, for example.
All right. Hey, let's go to question number 2 because you kind of gave us a little segue right into it just a second ago. And we're going to use that T word, transitory. It's just simply this. Do you, Lyn, believe that all of this inflation pressure that we're seeing is in fact transitory, as the Fed keeps repeating?
For the most part, no, but it depends on a couple of variables. And so, we've seen kind of rolling types of inflation. So we had relatively transitory inflation in things like lumber. And then we've seen, semiconductor shortages, which are more long lasting, more persistent. So they're driving up things like used car prices. So that was like the second wave of inflation. And the one that I'm really watching for, towards the end of this year and into early 2022 is rent inflation. I think that's, just heating up, rent inflation and the way that they include shelter in CPI. And so that part's, likely not going to be transitory. Now, after, say, 2022, whether that inflation remains persistent or not will largely depend on whether or not they do more fiscal spending or if they pull back and kind of revert to trend. But I do think that this current round of inflation is probably stickier than consensus expects, and I think that rent and shelter inflation is probably going to catch people off guard.
Yeah. Do you see the word transitory as kind of a jawboning form of yield curve control, trying to keep the bond market down or rates down?
I think that's a good way to describe it. So that's kind of, one of my themes over the past couple of years is that because of where we are in the long-term debt cycle, the Fed doesn't have much of they're basically stuck, right? So if they raise rates, they crash the debt markets. And if they, keep doing what they're doing, then inflation runs hot and you get deeply negative real yields. And so, they've kind of chosen that second option. And so you have this environment where inflation's running pretty hot, but they're emphasizing that it's transitory, to make it so that the bond market doesn't freak out. And we also see other factors like the Treasury general account has been drawing down, which means there's not a lot of new supply of treasuries, even though the Fed's still buying $80 billion a month in treasuries. And so I would consider this basically a form of soft yield curve control. They haven't formally locked the long end of the curve, but they're holding the short end of the curve near zero. And then they're buying large amounts of, across the duration spectrum.
Yep. All right. Hey, let's focus again on the central banks with question number 3. It sure seems like these central bank digital currencies are on the way. You're getting more and more trial balloons on those, it seems, on a weekly basis. What role do you think gold might play in a world of central bank digital currencies?
Well, for one, is we still see banks buying gold, right? So central banks. So Russia's a big buyer, but countries like Thailand, there's multiple countries around the world that have been buying gold, especially since around 2008. That kind of long-term trend reversed around that point and hasn't really stopped. So gold remains a reserve asset for central banks. For people, the thing about CBDCs is that they're surveillance tools, right? There's also kind of been a general trend towards wanting to phase out cash, make it harder to remove yourself from the financial system. And so that's why independent bearer assets, whether it's gold or Bitcoin, whatever their person's persuasion is, silver as well, there's certainly a value in having these alternative monies that are basically outside of that system that you can transact in, that are harder to surveil, that are harder to kind of lock into the system. So I think they're valuable both from a central bank perspective and from a user perspective.
I like that term. I've not heard that before. Individual bearer asset. I think that's great.
Yeah, and I mean, so cash is a bearer asset too, but of course,
Yeah.
the problem is that deeply negative real rates means you can't realistically hold a lot of cash outside of that financial system because you get devalued.
Yeah.
And so people can choose between cash, gold, Bitcoin, silver, and so whatever their preference is. But basically, those kind of more scarce inflation adjusting assets certainly have value in this type of environment of the combination of negative real yields and this push towards anti-privacy, pro-surveillance, kind of these schemes to kind of maybe phase out cash and kind of lock people into this negative real rate environment. Mm-hmm. So I still find them valuable.
Yep, no doubt. Well, we're having so darn much fun, Lyn. We're already halfway done. So let's move on to question 4. This something that came up last week. Peter Thiel's company, is it Palantir? I don't quite know how to pronounce it. But his big company is buying what is about maybe a metric ton of gold for about $50 million. Also announced they're going to accept gold as payment. Do you see any significance in that announcement?
Well, I mean, that's certainly significant. And it's kind of, it's interesting because you've seen a trend for a couple companies, a handful of companies, actually a pretty good number, putting Bitcoin on their balance sheet. And so this is an interesting move to see one of the companies put gold on their balance sheet. And it's one of those things where it's a small percentage of their cash position, so it's not like they converted all of their cash to gold, but they did use that as somewhat of a hedge. And so I think it's interesting, especially because they're pretty tied into intelligence communities and things like that. So they actually it's pretty interesting that from their perspective that they want to own some gold. And I believe they already accept Bitcoin as payment. So basically, they're open to things that are just not cash, right? They want something that is scarce. And in gold's case, of course, it's resistant to cyber attacks. It's resistant to power outages. It's it has these various kind of safeguards built into it. And from my understanding, I didn't look into that news as much as I probably should have, but my understanding is they took physical delivery, so they're not holding, some like ETF or something. They actually, took possession of the bars, last I heard.
Yep, they said they were going to hold it. It looked like at a COMEX depository because they said they were holding it in the Northeast U.S. in a vault somewhere. That sounded like COMEX delivery even. And the other part about that, as you said, the connection of the company is deep, the government connections. And didn't they say something about worrying about a black swan event, something like that?
I believe they did, yeah. And so, based on where we are in kind of the long-term debt cycle, we're in one of those environments now where you could have, what should otherwise be a low probability event happen on a random Sunday, some sort of currency announcement, some sort of something like that. And so this is an environment where you want to have some real assets. And people, of course, some people like to trade around those positions. But there are these things that can just happen on a Sunday where you don't get to trade around it. And so establishing position ahead of time in some of the things that you consider to be defensive assets is in my view, worthwhile. And they're doing the classic thing where, they're not making a giant bet on gold, but they're using it as insurance. They're putting a portion of their assets into this, so they have this as like a hedge or a safeguard.
Kind of like what a lot of us individuals have done over the years, that's for sure. All right, Lyn, just drawing on your experience of kind of generally looking at all markets, let's tie this question. It has to do with the mining sector, but I think it is value investing in general. It's so currently out of favor, the sector, but then just this notion of value versus growth. When and how might that bias change?
I think it's largely tied to growth and rates. And so we've been in this long-term environment. You can actually kind of separate into a couple different epochs. So if you look over the past century, value has outperformed growth. But ever since the early 80s, when you've been on this kind of, this structural, 4-decade trend of lower and lower interest rates, gold growth has done very well compared to value. Now, there have been individual decades, especially like the 2000s, where value outperformed. But generally, we've been in a very strong growth environment where lower and lower interest rates allow these kind of high growth companies to be bid up to very, very high valuations because the discount rate is just so low. Now, if we were to get more persistent inflation, potentially higher yields, but like as we discussed earlier, there's basically types of yield curve control in place. But when we get higher levels of inflation, that can put more pressure on some of those high valuations of equities. And so, another way to look at it too is that the fiscal stimulus is inflationary, but it also in some ways ends up being pro-growth, at least in certain areas, like demand for energy or demand for manufactured goods. And so that kind of that trend we've been in for a while, I think is going to reverse. The other thing I'd point out is that especially the past decade, we've been in this commodity abundant environment, right? So with the introduction of shale oil, with overproduction of copper, things like that, we've been in this period where we've been in a long commodity bear market, and so that's that puts downward pressure on prices. That's part of the value sector, the energy and the mining sector, and so when we kind of shift more towards a period of scarcity, which I think is what we're headed towards, those sectors in the value side probably should do pretty well, and that can put more pressure on the growth sectors, like consumer discretionary, right? So if your rent's going up, if your gas bill's going up, you have less money to spend on discretionary goods, and so I think that pendulum is probably shifting more towards I still own some growth stocks, but I do think it's shifting more towards some of those out of favor value types of areas.
All right, Lyn, I saved this one for last. This is one that I've been thinking about quite a bit, and so I'm curious to hear your answer. And you kind of referenced this earlier with the Fed setting up their repo facilities and making them permanent, it seems. We now have over $1 trillion in reverse repo volume. It seems that locked in and growing every single day. So does the U.S. risk negative short-term rates, nominal negative rates, in the next crisis or slowdown?
They do risk that. They've been pretty hesitant against that so far. They've taken measures to prevent that from happening, and so they have that 5 basis point rate, for example, on the reverse repos. And so, if we have another downturn, it's possible they'll go there. But I think that they've the Fed at least I think has looked at Europe and saw that going negative interest rates doesn't really help, right? So if you're in another type of regime, lowering interest rates from 7% to 4% can help spur, loan demand and things like that. But when debts are so high, people are making a decision to take out credit or not based on, if interest rates go down 1%. They're choosing to take that on, whether or not they think they'll be able to use that money effectively and pay it back. Banks are also, they're more concerned about, the possibility of that loan not being paid back rather than, that specific, that's that how many basis points spread they can get on it. And so overall, I think that they might turn to that, but I think they are starting to realize that they've kind of run out of monetary policy room, and lower interest rates, especially into negative territory, doesn't give them the nominal GDP growth that they're looking for. I mean, if anything, those negative rates, basically that's withdrawing money from the system, and so that kind of runs counter to some of their goals. And so I'm kind of hoping they don't go that route, but we'll see.
Right. I mean, do you think unwittingly they'll be forced there just because there's so many dollars laying around, thus that reverse repo volume, but yet not enough places to put it?
So I would describe it in two different ways. So basically, in 2019, when we had the repo spike, there were too many treasuries compared to bank reserves. And in this environment, we're somewhat in the opposite problem now. The Fed has done so much QE. And we've had the Treasury General Account drawdown, so there's not a lot of treasuries being issued. And now they've actually gone deeper than they expected due to the debt ceiling issue, which we're probably going to see a resolution to that later this year. But for the moment, that they're not really able to issue treasuries on net, and so we have essentially a collateral shortage. And so that can push rates into lower levels than the Fed expects. Now, as we go out a little longer. And that TGA situation resolves and they issue treasuries again, I think that could reverse it to some extent and basically supply more collateral to the system. And when it comes down to the next economic downturn, kind of the separate point, the two levers they can pull are they can keep doing more and more monetary policy, so they go negative rates, but we see that doesn't really work that effectively. Or they can do what they did back in 2020, where they do the fiscal spending. And they see that that's a lot more impactful. Of course, it comes with inflation, part because it's impactful. So my base case is that we're going to see more of that, where they're holding rates very low levels and doing these kind of rounds of fiscal spending to get nominal GDP growth, inflation levels well above the interest rates. And so you're stuck in this long-term environment of negative real yields and these round of fiscal. But basically the monetary policy is mostly a Fed decision. Whereas the fiscal policies that that complex mix of politics, and so you can get gridlocks, you can get all sorts of things, and so that the timing of that can be a lot more challenging to monitor. And I think a big question in the United States will be what happens with the 2022 elections.
Great stuff, Lyn. Again, we've been speaking with independent analyst and investor Lyn Alden of the Lyn Alden Investment Strategy newsletter. You can find that at lynalden.com. And again, just a reminder, all of this content is sponsored by Sprott Money. So anytime you're in the market for precious metals or precious metal storage, Sprott Money is, a reminder, a fully insured global precious metal storage service with some of the lowest storage fees in the industry. So anytime you're in the market for metal or storage, just go to sprottmoney.com/storage, or of course, just give them a call, 888-861-0775. Lyn, thank you so much for your time. This has just been tremendous. I hope we can do it again sometime.
Happy to. Thanks for having me.
From all of us here at Sprott Money News and SprottMoney.com, thank you for listening. We'll have another Ask the Expert segment next month.